Hi, this is Randy Finney with Right Side of the Chart, and today is Thursday, July 12th, 2018. In this video, I want to take a detailed look at the semiconductor sector, and what we'll do is there's really actually four goals that I want to hit in this video. First and foremost, I want to show just how large and profitable the trends in the semiconductor can be, and that's both on the long side or short side. Fewer sectors out there. Um, Very few have the potential in such a short period of time to produce gains such as the semis. So there's only a handful of sectors if you get on the right side of that trend, some very profitable trades. So we'll look at that real quick. Then of course I want to make a case for the next trend. There's no point in showing you, hey, here's a great trading op, but let's take a look at where the next trend will be, see where we're at in that stage or how far away we might be from that cycle. Obviously, the trend has been up. Now it's questionable whether a new downtrend's begun or not, but we'll get into the charts and I'll let you be the judge of that. Of course, I want to show you some trade ideas within this. So, time permitting, at the end of the video, I want to go through some of the individual semis. We'll take a look at just a handful, maybe no more than 2 dozen. I'll look at the components SOXX. This is usually my preferred trading proxy. There's a couple ETFs out there. We'll look at some of those proxies as well, and that's where we'll wrap it up. So my fourth goal is to show you some proxies for trading the semiconductor sector, and I want to debunk some myths or let's say half-truths about using some of the various leveraged ETFs. So let's dive into the charts. Start out first showing just how profitable the trends can be. Now, given on this chart, we're looking at, by the way, if I don't make mention, it's up here in the upper left-hand corner. On these dark charts from TC2000 always have the symbol right up here, and you can also see there. So we're on a monthly time frame, so every candlestick is 1 month. This goes back to all the way back to 2001. The sector itself, you can go back farther, but that's when this ETF started trading, and this ETF tracks the PHLX SOX semiconductor sector. And again, I only in this for the sake of this video, because the next trend will obviously at this point will be a downtrend. We're well entrenched into an uptrend, a bullish trend, or have been for a while. And so what I did here is just marked the drops from highs to low, and you can see there's a couple things that stand out to me on the chart. Besides the percentage drops, these are rough. I rounded off to the nearest percentage or so, and what you can see is there's each trend is defined by fairly well-defined uptrend lines, and that makes this sector also a very tradable, for lack of a better word, a tradable sector. There are some sectors out there, choppy, erratic, hard to tell when to get a buy or sell signal, but you can see, and that's the cyclical nature of the semiconductors. And when we look at Intel, the leader, we'll get to that. But you can see the semis move in pretty well-defined up and down trends. There are periods of sideways trading ranges sometimes, and they can go on for a while. But for the most part, it's a pretty trending sector, and it's either an uptrends or downtrends. So again, you can see the corrections going back to 2001, and I measured from highs to lows, but each of those, obviously you're not always going to get the highs of a sector, and you're not going to sell or reverse and go long at the lows. But if you capture the bulk of it, you can see you're looking at 66% correction or bear market, 38%, 27, 68%. 32, 22, 28. It's the last correction that we had. And let's forget about this whole semantics of bull market, bear market. These are just corrections, if you will, within at least from this point here. This was a bear market in semis. In fact, all the way back from 2001, you can see this point back there to the left of the chart was the highest point up until the low. So this was what we'll call a bear market, the overall bear market in semis, and this has been a bull market in semis. And these were just corrections or bull market and bear market rallies or trends within there. And of course, again, I showed you the trend lines that have acted as support and resistance, or support in this case for these the semiconductor ETF, and you can see backtest breakdowns. And some of these trends are powerful. This one that we're in right now is about 167%. So again, just for the sake of this, because the next trend will be down, whether this uptrend continues for a while, but you can just eyeball this chart and see that it's very long in the tooth. And let's just go back here to where this one bottomed. 22% again is a drop from the highs to the lows. So 32 would be from this high to this low. And back here, the previous trend bottomed back in 2012. Yeah, July, and really didn't kick off here till about the end of 2012. And so again, this is more so, this is where the semis really took off. They had this corrective phase, and they've continued really from this point. There was a period of consolidation. Now, I want to make mention here that, I don't always get them right, but I try to learn from my mistakes. Now, I was bullish back on the semis back here, and identified this trend coming up. In fact, let's take a look here. I have that post. This post goes all the way back on the site to January, yeah, right in the beginning. So that trend, like I said, kicked off in December, late 2012. In 2013, I posted Semiconductor setting up, and they're setting up for a bullish trend. And I posted these charts on the weekly time frame. The weekly time frame is where you want to identify, trend trades, not just swing trades lasting days or weeks, but these are trades lasting months or years. And so this was XSD, and I identified this large falling wedge pattern. That's a bullish falling wedge, positive divergences in place, everything you want to see. And as well as on SOX, we had this large symmetrical triangle pattern with this minor downtrend line to signal the first buy signal. And then, of course, if we broke to the upside of this triangle, which was my favorite thing. Now, again, had I just put everything in the semis and let it ride, great, but we would have almost certainly been out, and maybe I was back at that corrective phase. So again, let's look at XSD back in heading into early 2013, and SOXX, and I still have those charts annotated as such. This is SOXX. Let's see, what board did I use at the time? Hey, there it is, right there, board number 1. That's that same triangle pattern. That doesn't look like much here because we've had such a move, but there it was. There was that first buy signal. Boom, we broke out, we back tested it, and there you go. So point is, I do my best to capture both bullish and bearish trends. Certainly didn't milk this one or from here to the full extent, but again, the reason I'm doing this video is to catch the next trend on the downside, because as I just showed you, they are very profitable. Fewer sectors out there can give you easily double-digit returns, sometimes triple-digit returns if you get on the right side of the trend. There's XSD. This is that the same lines I had on that chart back then. Bullish falling wedge. There was the divergence somehow left. Sometimes that happens when I change these boards around, but there was your positive divergence. And so again, guys, this is what I look for to really identify in advance major trend changes, and that was SXD. And you can see perfect breakout and back test it to the penny there, to the button. And then we formed this uptrend line, and that broke, and that was a heck of a correction right there. It may not look like much. It's log scaling on this chart, and when you have a security that's moved as much as these have, it's a completely different technical picture when I flip to arithmetic or linear scaling. So I think it's imperative to use log scaling when you have a security that ranges down from the low single digits up to almost $80 or so a share on the chart you're viewing. That's where, again, log scaling is going to make the most sense in my opinion. Okay, so a lot of time there spent talking about just how big these trends can be. And the reason I spent so much time on that, nearly 8 minutes talking about that, is because it sets the stage for, if you get on the right side of this trade and you make 5-6% on a trade, especially if you're in SOXS or XOXL, one of the leverage, I think you're cashing out too fast. Over trading, letting your profits ride, and cutting your losses is a key to trading, but most retail investors do the opposite. They let their losses run and they cut their winners. And so again, we're going to try to get on the next side of this trade here, and it may be an official trade very soon. I might even put it on this week. I'm personally short the semis now, and again, may add that as an official trade. Now, whether I'm personally short or not, that's up to you. But wanted to show you a couple, make the case for which proxies to use. Now, a lot of you out there, I know from over the years, there's a lot of retail investors that don't short. They either don't have a margin account, they don't know not comfortable shorting stocks. maybe they want to gain short exposure profit from a pullback in the semis, for example, in their IRA accounts where you're not allowed to short. In that case, the short ETFs are the way to go. It's about your only way to go other than options, and stay away from options if you don't know what I'm talking about or aren't very experienced. There's a couple of them out there. SSG, if you don't want a lot of leverage, excuse me, SSG is an ultra short semiconductor ETF, but my preferred proxy is SOXL, which is a 3-time long semi, and SOXX. I'm sorry, Sam Oscar X-ray Sam. And the reason for that is this one tracks the index that I like to chart. Now I'll follow all the major indices or sectors ETFs. I'm sorry, XSD, SMH, and SOXX. I like to just look at them all. They're a lot of overlap. They're semiconductors. They're just different companies, so they have different weightings. But when you trade SOXS or SOXL, that those two inverse, they're 3-time leverage. Keep that in mind. The SOXL, L for long, SOSS, S for short. Those are tracking the same PHLX SOX semiconductor index. Therefore, I can use the charts because over time you will get decay. I talk about that a lot. We're going to talk about it here real quick. If you're not sure what I'm referring to, go to the FAQ page on the right side of the chart under the ETF related questions. I talk all about it. And just one quick, we can eyeball it here. No, before we get into that, all right, let's just look at where the chart that we're on now. This is a weekly chart of SOSX. Again, the ETF for that index. And there's the drops right here measured. You can see nice clear uptrend lines. And what I did is I measured from highs to lows, not where the trend line broke. I'm just telling you, making these calculations. This was the entire correction on the squiggle lines, roughly. Again, I rounded off to the nearest percentage: 28%, 32, 22, 18, 20. This one I zeroed in. I'll get to in a minute why. 28.43% from the highs. And that was our last correction, guys, that we've had. Well, significant. We had one and we caught it on the site. I'll get to that in a minute if we get to the daily charts. It was right up here and it was pretty decent. We had our first target, but this was the last decent, real, let's call it a correction. The last one was just a blip, if you will. And again, so what I want to show you is a couple things. You can see how well these trend lines work to define and get you in. Maybe not at the top, but certainly the bulk of that move. And here's a trend line break and a back test right now. Okay, where am I going with this? Here we go. We're gonna look at these numbers real quick, and I've inverted them, or I went added those numbers to SOXS. It's a tongue twister for me for some reason. All right. So that chart we were just looking at goes back a little farther because remember, these are ETFs. Some of these ETFs come to market later. So when I go back, this one goes back to 2010, and that must be when this one began trading. So this was again, we're looking at the inverse, 3 times inverse or bearish ETF. Now, look at the scale, look to the right of the chart. And again, I use log scaling. I feel it is imperative on weekly charts. If you look at arithmetic scaling, here's what you see. You can't chart this security over the last few years. See this price compression? That's because the price range is from $20,000 down to $10,000. You must use log scaling or you're not going to be able to chart this thing. Log scaling just puts all the candlesticks, all the moves in percentage terms, not dollar terms, because a $10 move on a $40,000 share price is insignificant, where a $10 move on a $10 share price is a double. If it goes up right now to 20, it's gone up 100%. Goes when it was back here, and you're probably wondering why is it 40,000 split adjusted? And so this chart tells us two things. It tells us the common perception out there, or common belief, that stay away from leverage ETFs. They're the scourge. They're going to ruin you. Especially if you hold them for more than just a day trade. Yes, that is absolutely the case, especially if you hold them, particularly if you hold them at the wrong time. And again, I write about that extensively in the FAQ page under the ETF related questions. You need to get in at the right security and at the right time. You don't want to buy and hold these. If you had just bought this thing when it came out, that's your split adjusted basis. In other words, if you put in another way to look at this, if you put in $20,000 back here, it'd be worth $10,000 today. Yes, you would have lost that much. These are all reverse splits. That's why you see that crazy share price. And this is a testament to how bad the decay can be in these three-time leverage ETFs, especially if you're fighting against the trend or you get in a lot of choppy back and forth at price action. That's really what does it. But as I say in the FAQ page, I'm like, I consider myself, one aspect like Christopher Columbus. I told him the world was flat. He thought it was round. So what did he do? He set sail to prove them wrong, the majority. I look at that, and so people say, well, ETFs are horrible and leverage ETFs are horrible buy and hold investments. They are usually, as I just showed you here, but not at times, and that's what I've done here. The same corrections that I showed you a minute ago on SOXX, the actual index that this is tracking, or the index, the ETF that tracks that index, that dropped 32%. And again, this is a three-time short. So you would think at best you would be up 96%, right? 32 times 3, wrong. You are up 137%. What I did, again, same points. I measured from on this the lows to highs, which on SOXX would be highs to lows. That next correction, again, on that chart we looked at, would SOXX drop 22%. Instead of gaining 66% or even less, as some people might say, because that correction lasted months, this one gained 92%. 18% drop in the semis, 67% gain. And then the most recent one, that's what I told you a minute ago, zeroed in. We had a 28.43%, rounded off, 28% drop. So one would expect, at best, without any decay at all, that you would be up, that this ETF would have been up 85.29%, and that wasn't the case. It had gained 143. So again, I'm talking a lot about this. You might say, okay, I got it, got your point. That's what I'm trying to capture here. If we get into one of these trends and we can capture, let's say, a 30% pullback in the semis, and you are long SOXX at that time, you will most likely, I should say, I can't guarantee anything, be up well over 100%. So you're looking at a triple digit trade and a 30% pullback in the semis, especially from where we're at now. That would be my bare bones minimum target. I think there's a lot more. And again, I started the video showing you the trends, just how those, what those pullbacks look like in the past. Again, everyone on here is, what is that? The lowest correction that we've had in the last few years is right here, 18%. So you can see where they range. So there it is. A lot of time spent on that, and then what to use. And the benefit of SOXS is several fold. Number one, it's three-time leverage. You can, if you're a somewhat conservative investor, you want to have short exposure in your IRA, but you're also long there. Instead of tying up, let's say, $30,000 in cash in a short non-leveraged or a short position on SOXX, you can go with 10,000 SOXS and give yourself a net short exposure of 30,000. So there's a benefit there as well. All right, now we'll move on. I hopefully have sold the benefits, but again, you got to be in the right time. If you're in the wrong time, you're fighting a trend, or you're in a choppy market, this is when you get decay, and that's kind of what I'm looking at here. This is SOXX again, the actual, the sector ETF. This is a choppy market. This isn't good for a buy and hold on SOXX or SOSS, or I said that wrong, SOXS or SOXL. You don't want to be in those three-time leverage at this point, ideally. And we had a short right here, and we captured that run. Then we hit the first target, got out. Even though I had additional targets on, on the official trade, I made clear that I was getting out. In fact, reversed it to a long. And what am I talking about right here? This is where we shorted. Actually, it was this one, I guess, because there was T1 right there. So we caught that, covered it, first target, reversed, and I still think over time these additional targets get hit. Okay, now to run through the charts. I usually spend more time looking at the charts, but I wanted to really go through, how, what this sector is all about, and just how profitable it will be when that next trend comes. I think based on the scope of this recent rally, we're looking at a correction when the next bear trend starts in the semis. It will probably be much larger than these low end, these 18, 22% pullbacks. We'll probably be looking at one. Again, you go back longer in time, and you can see here some of these bigger corrections, 66%, 68%, based on how much we've come up, how overextended we are, and where we are in the economic cycle. Undoubtedly, in the eighth or ninth inning, you can argue that all day long, but that's most likely where we're at. So therefore, don't underestimate how much these can fall. Now let's look at the charts, and we'll go through some of the individual stocks. That'll give you entry points and price targets, and a bigger picture of timing on this sector. Let me just go back to this daily chart, and let me give you a cleaner version of this here. The bigger picture, to me at least, we've already broken trend, but we've been working in the sideways range. This looks like a sector that's topping. If you want to play the glass half full, you can say period of consolidation, we're going to break out. But look back historically. Look how much the semis have come up from where they are. Look at valuations. Look at where we are in the cycle of things. And again, we're going to see at some point there'll be a glut of semis on the market, demand will slow, and then prices will crash as they always do. And that is why, by the way, this sector is so conducive to holding those three-time ETFs long and short, because these guys rarely do this. This is when you don't want to be in. I did say that, but there are the majority of the time when you go back for decades. This is what the semis are doing. They're trending. Semis are very cyclical in nature. So again, back to what I was saying. What am I looking for right now? Well, we need to break below this trading range. That's it. I boxed it in there. That's the most important thing to me. You can see a lot of reactions back here, here, and so this will be once we make a definitive break, an impulsive break below that trading range. I think it's safe to say the nail will be in the coffin for the semis. I believe it'll happen, and that's why I'm positioned ahead. But I'll most certainly add that on, and if it's not an official trade before then, it will be at that time. So that's what we need to see happen. And let's go to the weekly chart and run through some of the other components, because I have a watch list here just below, and I have all the components of SOXX sorted by descending by market cap. So the first one I'm going to click on, that watch list is off the screen. It will bring up all the components here. This is Intel. We're going to start with a weekly chart. And again, this shows a couple things stand out to me when I look at this chart. The scope of these corrections, and again, the rallies are just as powerful, but right now, based on the technicals, I'm not looking at that. I'm looking at the next correction, and I think it's already underway. I think we have a sell signal on the world's largest, the leading semiconductor stock, Intel, right here. We have a clear bearish rising wedge pattern. Again, I've covered this on the daily. We've broken down. It was impulsive. We had an impulsive red candlestick close, weekly close below, a second weekly close. This is, to me, just as simple a kickback rally. And yes, I think Intel is an objective short here. We'll get to the charts, and I think it's coming down. As I've covered this stock. I don't know why I have these numbers here. They're overlapping. These were, from whatever point I added these, my minimum expectations, my targets, a 24% drop and a 32% drop. That's not from today. Again, it's from wherever I did that before. So now at this point, it's already played out. See, now we have about another 18% downside to my first target. And then my final target, about 26% downside versus where we were before when I highlighted that. And you can see these were the other corrections within a bull trend. Now, just for a second, try to imagine what will happen if this great, second longest or going on the longest bull market in history. Just think what will happen if that's over and we embark on the next bear market. Then these are corrections within a bull market. So then you're looking at, probably 40-50% or more. And again, it's happened many times in the past on Intel. Here's a chart of Intel going back to the dot-com bubble. 75% drop from the highs, and not just from the peak here. I didn't go from here down to here. These are just these lines. The lines show the correction: 75%, 65%, 43, 42, 57, 28, 34, 34. We haven't had a correction then. So a lot of things stand out to me. Look at first of all, the cyclical nature of the semiconductors, and Intel shows it very well. Semis go in booms and busts. There's very little in between. They're either in a bull market or in a bear market. Yeah, every now and then you get a period of consolidation, but this is what I'm trying to say here is fewer sectors are so cyclical as the semis. There was that little bit of consolidation within this bull trend. And so this is what I'm looking to capture, this next down move. And looking at these numbers, the lowest drop that we've had in again, going back 2 decades, is 28%. And on average, if I'm just eyeballing this, is probably, closer to 40% pullbacks. And this was again during a bull market, at least from here to here. This was a bear trend. These were bear market numbers, and that's why they're higher. And then these were bull market corrections. So the next bear market, it's only logical to think that we're looking at something between these numbers here, a blended average around 50% or better on Intel. And back to that weekly chart, that was a monthly we were looking at a second ago. Again, the case now is Intel is broken down, clearly broken below that bearish rising wedge, had negative divergence at the highs. So that's why I'm doing this video. I know the QQQ is rocking today. It's up nice, 1.5%, one of the biggest gains, but yet that doesn't matter. A lot of people think as tech when they think of QQQ, which it is, and of course when you think of tech, you think of semis. But I think semis are going to lead the way down, and they already have. They're already underperforming the broad market. All right, a few more and we'll wrap it up. Taiwan Semi. Again, we're on a 10-year weekly time frame as we just were with Intel. This is the trend line right here. Very well defined, this yellow uptrend line. This is my primary uptrend line off the mid 2015 lows. Breakdown, not only was there we didn't just limp through there. We broke down with a big red impulsive candle. That was confirmation of that breakdown right there. And again, trend lines don't get much better than that. You go back, look how many reactions off that trend line. And of course, everything I like to see, the fact that we had negative divergence on the weekly time frame. So here's another stock that, in my opinion, the bull market is over, just like Intel has ended, and it's in the early stages of a new bear market. And yes, I'm saying that as the Qs rocket. Everyone wants to buy stocks right now, but that's why I'm doing this video. I'm looking at things that other people might not be looking at, and Nvidia, another one, uptrend line broken. Now this one, you see powerful divergences. It's not playing out yet, and this is a function of a couple things. The broad market's holding up. The FANG stocks, which really don't have much to do. Of course, Intel. Well, the Intel's not one of the FANGs. It's right outside of there. But Facebook, Amazon, they're not chip companies. Sure, they're thrown in the realm of tech, but what's happening is the broad market's holding up. Money is going into those other companies, so it's booing some of the semis. And once we see all of these crack, here's all these lines on here are support levels. We see 187, 187-ish level going Nvidia, as well as a lot of these other leaders. Then you'll know that the bull market is under, or the next bear is underway. And again, you might not want to short at that point if a counter trend rally is likely, but don't underestimate how far these can drop. That's what I'm getting at. Texas Instruments, there it is. This one has not broken. So here's one that we're waiting for confirmation. And I'm doing this video again because I'm going through these in order market cap. So as we go down the line, you need to see the big ones break. So far, the first two have broken. Nvidia has broken trend, but really sort of in a sideways topping pattern. Texas Instrument needs to go. So when we see Texas Instruments break that trend line, we have a very important support level about 98.30, and that's we're seeing that with a lot of these semis. You see this box range that I covered. So really the nail in the coffin for Texas Instruments comes on a weekly close under 98.30. But of course your first sell signal would be a break of that trend line. And then Broadcom, that one broke today, a big giant, like a 15% drop. Yeah, I know it has to do with the merger acquisition going on. But that's definitely a technical breakdown. You can spin it to any news you want. It doesn't matter. The news triggers the technicals or follows, and there's a breakdown of that same comparable sideways trading range, which comes after a breakdown and a back test of this primary uptrend line. So a lot on this chart, and there's a stock that before all said and done, would I short it today? Probably not. I want to see a little more evidence in the semis, but either a kickback rally to the 227 area, or if we flag here on the daily or 60-minute chart, again, this is a weekly, but this is where I think this one's heading before all said and done, 177. Qualcomm, I was bullish on this one here, trying to buy it. Did buy it a couple times off the back test of this trend line. Right now, it's a messy, sloppy chart, so let's not spend too much time. This one looks like an EKG recently with all these ups and downs. Not my kind of chart. ASML, this is again going down the line on market cap. This is about an $85 billion company. divergent high right here, breakdown of the primary trend line, 1, 2, 3 weekly candles below there so far, following that divergent high and trend line break. So there's another one that's broken down. Micron is walking the line right now. Micron, we get a lot of interest in this one. And again, you can see, look at these moves. Micron is extremely cyclical. If you get the right trend here, and this is not leverage, there's no three-time leverage here. This is a 67% drop during a bull market, mind you. These are just corrections in a bull market trend for Micron, but you're looking at 16% drop after that divergent high, 18% drop after this divergent high, 74% drop. That was a consecutive. I talk about this a lot. Divergent high number one was a little shot across the bow. We pushed up, continued to diverge, just like the NASDAQ 100 is doing right now. And I just think this will happen in the NASDAQ 100. Maybe not a 74% drop, but you can see a Micron. These are just a lot of meat on the bone on these stocks. And so here we are. Divergent high one led to a 28% drop. Divergent high two just happened, and now this one's struggling to, hold that trend line support weekly. Look at these candles, and we zoom in. It's amazing how technical analysis works. Weekly, we closed there that week. We hammered or tagged it, closed right above the trend. We broke it intra-week last week, but we managed to close right back above. That's why that's a green candle, meaning we closed here, not down here, and another candlestick just above there. So Micron needs to print a weekly close below there, and then it's headed down to my first target zone, which you can see right here, and you can see there I predicted, I guess, a few weeks back, 60% drop if it hits this target, which I think it will before all said and done, down around 26. We'll wrap it up here, maybe cover one or two more. This video's gone on longer than I wanted to, but again, a lot in here. There's applied materials. I don't, just kind of give you an idea. That divergent high led to about a 45% drop. And this is a key stock. This is a chip equipment maker. They make the equipment that makes semiconductors. So when demand slows, you see it first. These are the canaries in the coal mine for the chip sector, which is the canary in the coal mine for the tech sector. So when you see chip equipment makers start to roll over like applied materials, and there it is. There's that uptrend line, well-defined, breakdown back test, and like so many other semis, you have this box trading range right here, this toppy pattern, and you can see AMAT starting to crack below there. That weekly PPO, the trend indicator, the 9 EMA, which I like to use. The signal line is now below zero, indicating a bearish trend for the first time since back here, where again we had this big drop. I told you at this point what that white line was below, trend was bearish, and here it was bullish, here it was bullish, so there's a lot of evidence there. And again, we have a few more semis that need to confirm, but and that's what makes it tough, because and that's why I've been averse to adding back SOXS as another official trade, because if we grind around for another few months, that's where the decay sets in. That's where we underperform or actually lose money, even if the semis just trade sideways. So I got to get the timing right on this one, guys, and again, maybe I'll have a multi-tiered strategy, maybe scale into a short on SOXX. Maybe I'll give some different levels. But again, as an unofficial trade, I think you can short it here. Ideally, would have been the other day. You can see right here we have some resistance around this level. You can see it was capped here. Just give you some levels to zero in on. Cap that advance. We had some reactions around there. Cap that advance. We had some reactions around there, and it capped this advance about 184.55. So if you're short or looking to short, you want to short around this level with a stop maybe above that recent candlestick. But this is again, bigger picture. If you're willing to give it some room, maybe go with like a non-leverage or only a two-time leverage ETF until we break this range. Because once this sucker starts trending, and that will probably happen once this level goes. That's when the three-time leverage will actually work to your advantage versus holding three times as much of a SOXX. All right, we'll wrap it up here. Very long video, but again, I wouldn't spend all that time if I didn't think it was worth it. If there wasn't a high double-digit or possibly triple-digit trade to be made coming up soon in the semis. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.